Three Australians walk into the same Westpac branch on a Tuesday morning. Same suits, same haircuts, same loan application for $2 million. One walks out with approval inside 24 hours. One waits 6 weeks for a polite knockback. The third is offered a coffee in a room you didn't know existed. This is the three-tier system the Big Four don't advertise, but absolutely run. Here's the question. Australia has 4 banks that control roughly 3/4 of the mortgage market: CBA, Westpac, NAB and ANZ. To the average punter, they look identical. Same logos at the footy, same ads about helping you live your best life, same chatbot that can't find your transaction history. But behind the glass, every customer gets sorted into one of 3 tiers within about 30 seconds of opening an account. The tier you land in decides what your money costs, who picks up the phone, and whether the rules even apply to you. We're going to walk the same $2 million loan through all 3 tiers. And watch what happens. Start at the bottom. Call it standard banking, which is just the marketing word for everyone. If your savings sit under about 50 grand and your household income is under roughly 180,000, this is you, and me, and about 85% of the country. At this tier, you don't really have a banker. You have an app, a call center in Manila or Melbourne, and an algorithm that decides if you're worth lending to. The loan application is scored automatically. Serviceability calculator, HEM benchmark for your living expenses, a credit file pull, a buffer rate of 3% on top of the actual rate. If the numbers don't fit the box, you get a generic decline letter that doesn't tell you why. Our first applicant, let's call him Jake, 28 years old, $95,000 salary, $80,000 deposit on a $700,000 Brisbane apartment. He submits online at 9 a.m. By 9:04, the algorithm has him. LVR's 88%, so he's hit with lender's mortgage insurance, about $22,000 added straight onto the loan. Whatever the advertised standard variable is, around 6.4% right now. No discount, no negotiation. The bank knows he has nowhere else to go. Over 30 years, that LMI plus the rate premium versus what a wealthier borrower gets costs Jake somewhere north of $180,000 in extra interest. He'll never see a breakdown of that. It's just the price of being normal. Move up a tier. This is where it gets interesting, because most Australians don't even know it exists. Priority banking. CBA calls it Premier. Westpac calls it Black. NAB calls it Private Client. ANZ calls it Premium. The threshold's roughly $250,000 in deposits and investments, or a household income north of 250 grand, or a home loan over about $1 million. Roughly the top 10% of customers. You get an actual human, a dedicated relationship manager with a direct mobile. They know your name, your accountant's name, and which suburb you're hunting in. The branch has a separate room, sometimes a separate floor. Our second applicant, Sarah, 38, GP earning $280,000, husband on 140, looking at a $1.6 million house in Hawthorne. She gets a call back within 2 hours. Her banker walks her through the application personally. The rate she's offered isn't on the website. It's a professional package, typically 0.8 to 1.2 percentage points off the standard variable. On a $1.2 million loan, that discount alone saves her around $9,000 a year, roughly $270,000 over the life of the loan. She still pays LMI if she's under 20% deposit. She still has to clear serviceability, but the system is bending around her, not the other way around. The banker rings the credit team to argue her case. He flags her bonus income as recurring. He gets the HEM expenses reviewed manually. Same bank, different physics, and then there's the top floor. Private wealth, Westpac private, NAB private, Macquarie private, CBA private. The hurdle is usually $3 million in investable assets, or borrowings north of $5 million. We're talking roughly the top 1% of Australian households, and within that, the segment that actually uses it is even smaller. This isn't banking anymore. It's concierge finance. Our third applicant, David, 54, sold a logistics business 3 years ago, sitting on a $12 million share portfolio plus $4 million in cash. Wants $2 million to settle on an off-market Mosman property next Friday. Doesn't apply online. His private banker rings him. The loan is structured against his share portfolio, not the property. It's called a Lombard loan, or margin facility, secured against blue chips and ETFs at, say, 70% LVR. No LMI, because there's no traditional mortgage, no serviceability test in the standard sense, because the asset itself is the security. The rate? Often 1 to 1.5 percentage points below the advertised standard variable. He sees a draft term sheet within 24 hours. Now stack the three side by side on a $2 million loan, just to make the gap visible. Jake, if he could even qualify, would be paying around 6.4% plus LMI. Annual interest, roughly $128,000. Sarah at Priority would be on something like 5.6%. Annual interest, around $112,000. David at Private Wealth, on a structured facility around 5.2% with no LMI. Annual interest, roughly $104,000. The bottom tier borrower pays $24,000 more in interest every year for the same $2 million. Over 30 years, before compounding, that's $720,000. With the LMI gap and rate premiums layered in, the real lifetime spread between the top and bottom tiers on equivalent borrowing pushes past $1 million. Here's the mechanism nobody explains. The bank isn't being unfair, it's being rational. A wealthy borrower has collateral the bank can liquidate in a phone call. A standard borrower has a job, which is a thin, fragile income stream that can disappear in a recession. The risk is different, so the price is different. The catch is that the pricing isn't transparent. The discounts don't appear on the website. The product disclosure statement for Westpac Private isn't downloadable. You only find out the better deal exists if you're already inside the room, and the room itself is structurally Australian. The threshold for private banking lines up almost exactly with the people who benefited most from the 2000s mining boom, the post-2012 Sydney and Melbourne property run, and the franking credit and CGT discount regimes. The system didn't appear from nowhere. It rewards the asset base the tax code spent 2 decades building, which is why the tiers compound. Priority banking gets you a cheaper mortgage, which lets you buy the second investment property, which qualifies you for private wealth, which gets you the structured lending facility against shares, which lets you buy the third property without selling anything. The same bank that ignored Jake's emails is now structuring David's offshore FX exposure. So the surprising bit isn't that the system exists. It's how legal, how visible, and how rarely anyone discusses it out loud. A few caveats. Not every wealthy customer takes the bait. Plenty of high net worth Australians stick with online lenders for transparency. Mortgage brokers have closed some of the rate gap for middle-tier borrowers over the last decade, and the private banking division isn't pure generosity. Those clients pay through wealth management fees, advice fees, and product cross-sell that quietly recovers the discount. But the structure is real, the thresholds are real, the pricing gap is real, and the room exists, whether you've been invited in or not. Final thought. People talk about wealth inequality in Australia like it's an abstraction, a Gini coefficient on a chart somewhere. It's not. It's a relationship manager with your mobile number, a rate that doesn't appear on the website, and a coffee in a room you didn't know was there.